what should you do with your 401k when you retire? I don't mean to scare people, but this is a real issue out there, is that a single wrong move, Corey, with your 401k at retirement could trigger taxes that are completely avoidable, penalties, and potentially destroy legacy. Thousands and thousands of retirees each year saying to themselves, I wish somebody would have told me this sooner.
Right.
And so today, Corey, we're going to break it down step by step, what to do, what to avoid, and how to make your 401k actually work for you, not against you. So how about that for a show?
That sounds like a great show. Let's do it.
Okay, so let's get into some of those challenges that people face. So here's the big one, Corey, and I want to hear your thoughts on this, is that when the paycheck stops, your 401k suddenly becomes this huge lifeline. And it's also actually a tax time bomb. Like I think that's the retiree's number one problem or issue, Corey, is like, Jake, I no longer am working. I don't have this paycheck coming in every couple of weeks or however often they get paid. So now they got this big nest egg. Maybe it's $3, $4, $5 million. How in the heck are they supposed to turn this nest egg into a paycheck? Do you come across this in your meetings? I see it all the time.
Yes, all the time. I think this is, like you said, it's probably the number one challenge that people face is I've been saving this money for decades. How do I live off of it, not have to worry about running out of it, manage the taxes through all of it, and invest it properly? It's a total game changer in terms of the way that people approach that 401k in retirement, Jake, in my opinion. But you're absolutely right, because it is something that people don't really always know what to do with or recognize how important each decision they make actually is.
Yeah. So turning that into an income replacement stream is very difficult. And then you don't even know what to do with the 401k in the beginning. Do it, like you said, Do I roll it over? Do you just leave it where it's been the last 30 years? Or do you just cash it out and put it in your checking account? Like, people don't know how to manage this. It's a big transition. Most people have really only done this once. Maybe they've hopped around, a few jobs, so they've been familiar with doing it in the past. But many of our clients, Corey, they haven't done this.
Right.
And so you can have analysis paralysis where you don't know what to do, so you do nothing. And I'm telling you, that can literally cost you and your family thousands and thousands of dollars.
That's right. Yeah, and there's no manual, right, Jake, right, that comes with retirement planning. I know a book that someone wrote about retiring right. It's probably the closest thing someone can find. But the point is that 401k is the income engine, and there's no manual for how to operate it.
That's right, Corey. Yeah, I did write a book about this called Retiring Right, Smart Steps for Exiting Corporate America. Perfect time for a quick commercial, Corey. If you're tuning in to Upticks and you want a free copy of my ebook, Retiring Right, Smart Steps for Exiting Corporate America, you can go and click the link here, on YouTube or wherever you're listening to this on your podcast. If you can't find it, just email Luke@FalconWealthAdvisors.com and he'll kind of lead you to the landing page to get your free ebook. So here's the opportunity, though, Corey, is that this decision is not only about what not to do, but it's about, like I talked about, turning your 401k into a personalized income and keeping it a tax efficient engine. How about that?
That's right.
So if you're smart and you use strategic rollovers, you could potentially improve your investment flexibility. You could reduce hidden costs, and you could even enable some Roth conversion strategies down the road. And let's not forget that you might get enhanced creditor protection or estate planning opportunities down the road also. So this is why you should focus on your 401k options. And by the way, I'm not saying everyone should roll it over. That's not at all what this episode's about. Like that not necessarily is the case. Many times it's not the case. And we can go over those in a little bit here, Corey. But do you have any other opportunities that I missed here that again, it's not just not to do, it's about how do you really shape this 401k for you and your family?
Yeah, that's really right. That's absolutely right, Jake. I think the only thing I would probably add to that is the decision to do nothing is also making a decision, right? When people are thinking about how to manage their 401k in retirement. So the planning is so crucial.
Yeah, that's good, Corey. All right, so let's, do you have a real world story you want to share?
I do, Jake. So I wanted to share the story. So there is a client that I work with that was separated from their employer before the age of 55. They went and found new employment, Jake. They had a 401k from somewhere they worked for decades. And we wanted to enable cash flow management and tax management with their retirement assets before the age of 59 and a half. So for this particular client, Jake, we took advantage of the rule of 55 that we've talked about some here on this show, which has to do with accessibility without penalty from 401k assets. But we were very selective around what assets we actually rolled Jake out of a 401k plan and what we rolled into a 401k plan. So someone would actually have liquidity and access to their money before age 59 and a half. So my point, and really the story that I'm sharing here, is that this is a client with money in a 401k. We actually rolled some into a new 401k plan and some into an IRA because it ultimately made sense in their long-term financial plan. And this was something that this person was not really aware of around their optionality at age 55 that proper retirement and 401k planning can help solve for.
Yeah, that's really good, Cory. Yeah, and it's a little complicated, but that's the whole point, is that
Right. Yeah.
this isn't easy because, again, our clients have never done this before, but you and I have hundreds and hundreds and hundreds of clients where we've had a lot of reps and looking at these opportunities and decisions. I run into people that, have left their money in their 401k, right, after they've retired. They might have $2, $3, $4 million in there, Cory, and they don't even understand what fees they're paying, or they don't understand the benefit of rolling it over and doing a Roth conversion, which will actually reduce their required minimum distributions as they get older and are into their 70s. So we can literally help clients save thousands and thousands and thousands of dollars from taxes by executing on some of these strategies and potentially lower their fees. Their fees aren't always lower or higher, but they don't know. That's the problem I have with 401k plans, is they're not very transparent with their
No.
fees. A lot of people, Cory, think that they're getting them for free, and they're not. And so we
Right.
can do an x-ray and check these out and say, look, this is what you're actually paying. And by the way, they're not doing anything. They're not giving you any advice. So you're paying a fee. You're kind of just lumped in with all these other 401k plan participants. And for what? So oftentimes, again, we want to look at the pros and cons of all of it. But just in the tax planning alone, there could be thousands of dollars that we can unlock for you in tax savings over your lifetime.
One 401k plan to the next is not the same. And investment options that people have within their 401ks is not the same. So that's a really important part of this decision as well.
Right. You're exactly right. And a lot of people think like, can I just roll my 401k into my spouse's 401k? You can't do that. So
No, you can't.
again, the 401k is very specific to you as the individual. It's under your social security number. And so it's yours. You can't commingle that with a spouse. You either need to leave it in the plan, cash it out, or roll it over. But like you said, the options are pretty limited and into your silo of options here, where you can't just bounce it around. You can't even just move it to another 401k. Like it's it. Like,
Right.
So again, you got to be careful with those decisions. And I've got a framework that I wanted to share with our
Perfect.
audience today. So, but quick second commercial here, Cory, is that thank you to all of our listeners who are tuning in, whether you're watching us on YouTube or listening to us on Spotify or Apple iTunes. Thank you so much for tuning in. The whole point of Upticks is to enhance financial literacy. If you think our stuff's any good, a thumbs up, 5-star rating is much appreciated. Please like and share our content. Again, let us know if you want that free copy of Retiring Right, the ebook version. It's also available to purchase out there on Amazon if you're like me and you like to hold the book in your hand. Also, I'm very active on Instagram. So if you are in social media and if you're on Instagram, you can simply follow along with me at Jake_Falcon_CRPC. And Cory, you are Cory Bittner KC on Instagram. All right. So let's get into this 4-step 401k decision tree, right? Is the framework. Here's one way to look at it here. It's number one. So of the 4 steps, the first step is to assess the plan quality. What fees are you paying? What are your investment options? And what services are they offering? Are they doing tax planning for you as part of the 401k? Like you mentioned, Cory, if you leave your employer the year you turn 55 years old or older, but you're not quite 59 and a half, this is another good reason to potentially leave your money in that 401k plan if you need to access it. A lot of people don't know the rule of 55, Cory, and I'm glad you brought it up today, but that would be a prime reason to consider leaving the money in there. Now, the good news is you don't have to leave it in there the rest of your life. You're just leaving it in there to be able to access it, but you need to understand what fees are you paying, what is the investment lineup, and then what services is the 401k plan offering. That's number one. That's the number one step, is just let's assess the quality of the plan. And if you're like me, Cory, you don't want to be calling into a if I had $3 million at a 401k, I don't want to be calling some 1-800 number.
Right.
And getting some kid that's fresh out of college talking about my millions of dollars. I don't want that.
That's right. Yep.
I
know.
don't want that. Now you,
Same.
Mr.
Nope.
and Mrs. Joe Schmo out there, you may be fine with that. I don't like that at all. So, but you have to understand that. So you might say, well, Jake, their fees are only 0.001%. Great. You're going to be calling some 22-year-old kid to talk about your $4 million 401k. Good luck. So good, but you got to be aware of all that. All right. So then number
Yes.
2, let's talk about the tax planning opportunities. Are there opportunities for Roth conversions? Is there NUA potential? And can you map out your tax bracket? You being my guest, why don't you talk about NUA? Because this is a powerful 401k management strategy that we've used for many, many years with our clients. But why don't you explain NUA today for our audience?
Okay. So if someone is working for a publicly traded corporation and they have accumulated company stock inside their 401k plan, we've seen Jake someone has worked somewhere for 30 years and they've accumulated a lot of company stock in their 401k plan. And their cost basis, how much it costs to acquire those shares, is very low. So over the years, as the stock has continued to appreciate, the options that people look at, kind of even what we highlighted earlier, Jake, is, roll money from a 401k to an IRA. Maybe you do, maybe you don't. Sell the stock, etc. With NUA, what you can actually do is you can move the shares of company stock outside of the 401k plan into an account where you will only have to pay capital gains on the shares that you sell as you sell them, as opposed to paying ordinary income on all the distributions that you would take out of a retirement account. I challenged myself, Jake, when you just asked me this question. How can I explain this in as few words as possible? The main point here, though, is that you could literally save hundreds of thousands of dollars, especially if you have a lot of appreciated company stock in the 401k plan, that you should absolutely evaluate the opportunity for this before you do anything with the stock inside that account.
Very good, Cory. Good job on that, because it is
All
a
right, thank you.
complex. It is a complex. You want to talk about tax bracket management? This is exactly what we're talking about. So NUA stands for net unrealized appreciation. Again,
explain that.
If you work at a publicly traded company and you have company stock in your 401k, that is the trigger to talk with a fiduciary wealth advisor who knows what NUA is, has done it before, and crunch the numbers. That's it. That's all you need to know.
Good.
Right? Crunch the numbers, and we can map it all out for you. It doesn't always make sense to do it. If you don't have a large gain in your 401k, it might not make sense. But like Cory said, these capital gains rates can be anywhere from 0 to 20%, where your ordinary income tax rate could be as high as 37%. So we're talking about, so if it's the extreme, if it's paying 20% versus 37, we're talking about 17% tax savings. And if you've got $1 million of gains, I mean, that's real money. We're talking about like 170 grand. Now, this is not tax advice.
Exactly.
We're going to run this. Yeah, this is all hypothetical. We're going to run this by your CPA, by the way. First, you know what's sick, Cory, is that a lot of CPAs don't even understand this. It frustrates me.
I know. I think there's a lot, Jake, that we cover in this show every week, and I think there's a lot more that we have to cover today. But I think one really important takeaway from this episode today is that if you have company stock in your 401k plan, you should evaluate or at least understand what net unrealized appreciation is, because you're exactly right, Jake. I've met advisors, accountants, estate planning attorneys that just aren't familiar with this concept.
Right.
Because it's not something they've come across.
No good. And then let's not forget. So again, you may want to roll it. Maybe you don't have company stock in there, and that's fine. Maybe you roll it over to an IRA. But then if you're 60 years old, we start converting a little bit to a Roth every year. So this is what we're getting about. Option 2 here is that tax planning is so critical, because let's be clear. A lot of our clients, Cory, will have $3 or $4 or $5 million all pre-tax in an IRA, and it's not their fault. It's not their fault. Roth IRAs are a newer invention. Roth IRAs, many of our clients make too much money to put money in Roth IRAs, so they never had one. But now is the time to look at Roth IRAs when you retire, actually. And so that's another tax thing. So again, number 1, assess the quality of your plan. Then number 2, what tax planning opportunities do we have? And then number 3, Cory, of my framework here is to integrate with an income strategy. So when are we going to pull from Social Security? Do you have a pension? Do you have a brokerage account? And then when are we going to pull from this 401k? Do you have a Roth? So again, it's setting up this income strategy. And one red flag here is I hate it when I hear about advisors pitching annuities for people's 401k plans. So they want to roll over your 401k and put it all into an annuity, or even some of it into an annuity, to generate an income stream, because they say we can replace your paycheck by using this annuity. My point is, you don't need to use an annuity to generate an income stream. I've got a big problem with advisors pitching annuities as income replacement because you can buy dividend stocks, you can buy interest paying bonds. There's a variety. You can buy REITs, real estate and investment trusts. There's a wide variety of ways to generate income from your 401k that don't involve annuities. So don't think you need to buy an annuity to replace your paycheck. You don't need to do that. So the rare instance I think annuity may make sense for some people, and I've never sold one, Corey. I've been doing this 19 years. I've never put a client in an annuity. Can you believe that? Never done it.
I believe it. I know you well enough that I believe it. But go on.
And annuities do make sense for some people of the marketplace, but it's not typically our client. It's somebody that, and this isn't to talk bad about them, that they know themselves. But if you lack discipline and you are very worried about spending all of your nest egg down to zero, and you want forced discipline, then I think an annuity may make sense for that people. But instead, Corey, you and I try to coach people and advise them and help them with their self-discipline. But if you know that you're going to you just can't stop spending and you've got a real problem with money, an annuity might help you create some structure where you're like, look, I'm going to get $3,000 a month, Jake, from this annuity. And I know that's what I'm going to get. And that's it. I know I can't pull anymore. And I need that structure in my life because I know I will spend it and I'll be broke. But again, typically it's not our client because we haven't run across a client really. I mean, looking back, maybe we've had clients, Corey, in the past that probably could have benefited from an annuity, but I still wouldn't have sold it to them. I probably would have referred them to somebody to buy them one for them. But that's the rare instance. But my point is, for an income strategy, let's make sure you've got enough money in bonds to weather any market cycle. Let's make sure we know when you want to turn on Social Security. Let's understand your pension options. And let's take a look at your brokerage or other savings accounts and see what is that withdrawal strategy going to look like? How are we going to replace that income? So that's number 3 of the framework here.
Good. Yeah, ideally, let's not pay a premium to lock the money up, right? Which is often what we're doing with an annuity.
Right.
Or what someone's doing. Okay, good.
And then finally, so again, this is the 4th step, not the first step, but the 4th step is finally, do you decide, do you want to roll it over to an IRA or do you want to keep it there? And then we can weigh those options. Like, what does a rollover offer us? What are the in-plan benefits? But first, we got to look at your plan's quality. What are our tax planning opportunities? What are we going to do how are we going to pull from this account? Here's another issue I have with keeping it in the 401k is that if you want to keep it in the 401k and it's $4 million and we want to keep it diversified, when you pull from the 401k plan, Corey, many times the 401k plan doesn't let you pull it from a specific asset class. It pulls it out proportionately. So what happens then is something called sequence of return risk gets elevated, because if the market crashes and you're pulling from a 401k and you don't get to pick and choose what asset you pull it from, well, then you may be forced to sell in a down market. Whereas with us, when we roll it, we buy individual bonds and stocks for our clients. We can pick and choose where we're pulling the money from based on the performance of that individual asset. So you have to be aware of that. And that's a big problem if you're going to pull from a 401k plan. If they make you pull it proportionately, I've got a real problem with that, actually, if you want to keep it diversified. Do you have thoughts on that?
Yeah, no, I think you're exactly right. I mean, we're basically this is a very useful framework, Jake, because people think about that 401k. This is my experience, is do I roll it over or do I not? You've just highlighted everything to think through before you make that decision. You're exactly right about pulling funds proportionally. We don't want to sell something when it's down in value so you can take a distribution to make your mortgage payment or to pay your bills or whatever it might be. That's exactly what we're trying to avoid setting up. One other point around this, Jake, that we haven't talked about yet today is typically 401k plans require mandatory 20% tax withholding on distributions also. And something that I've ran into with clients is they don't need to withhold 20% in federal taxes because of the tax planning that we're doing. So they have more money coming out of their investment account going to the government that they're ultimately getting back in the form of a refund just because we can't control how much is withheld in the first place.
Yeah, that's a really good point, Corey. You're right. So you have a lot of structure, but you lose flexibility a lot of times. So that leads us into our myth for this week, Corey, is that the myth is that company plans are always cheaper or better. And what do you think about? I mean, why do people think that?
Good question. I think because employers have an incentive for employees to participate in their 401k plan. I know there's a lot of studies and data and surveys that even the big 401k providers look at too. So there's just a lot of incentive for money to stay inside of 401k plans for employers and for plan providers. But at the end of the day, I think you have to evaluate what makes the most sense for you. But that is a pretty common widespread myth, Jake, in my opinion, that it's always going to be cheaper. It's always going to be better.
Why do you think it matters that the employer, if you retire and leave your money in the 401k, you think they get benefits? Do you think there's perks in that?
I suppose there could be. I don't know, actually, to be clear. I'm not certain of that. But I think I do think that there's incentive for employers to, if nothing else, Jake, it's just keeping a connection to the employee or have an employee keep a connection to the employer.
Yeah, I don't know.
Maybe.
I don't think the employer cares when you retire what you do
Mhm.
with it. I think the employer cares while you're an employee because the whole point of a 401k plan for an employer, by the way, is to attract and retain good employees. That's
Right.
it. So I think they have incentive for you to participate and use
Mhm.
it while you're an employee, Corey. But I think when you retire, I don't think the employer cares. I haven't run into that. Like maybe, I don't know. But like you said, we don't know
That's fair.
fully. Like
But if for 30 years your employer told you how great the
exactly.
401k benefit is, like you're going to, after decades of hearing that, it's natural that people are going to assume that that's the best place for their money.
That's what I really think the issue is. I think that brainwashing is probably too harsh of a word because I don't think employers are doing it with ill
Conditioning.
intent. Yeah, but I think they're pounding that into your brain, the 401k, and it's a comfort level.
For sure.
And you know what? People are
For
ignorant.
sure.
And this isn't, I don't want to be harsh, but it's like, well, Jake, I've got $4 million in my 401k. Why would I move it? I was like, okay, well, you've also been maxing it out for 40 years and you've actually only been making 4% a year, you
Right.
know? But people
Yeah.
might not realize that. They might not
Yeah, you're
even know,
right.
or you're paying 2% in fees,
Right.
or you've got a concentrated stock position that needs to be managed now because the real issue is if you've got $3 million in a 401k and you've got 2 million in a one stock, that's very risky in retirement.
Right. Yeah,
It
that's a great
you
point.
might have gotten lucky and it served you well while you were working, but it's not really the place you want to keep your money in retirement if you want to kind of plug some holes and some planning. So again, the reality is there are limited options on 401ks. They do lack flexibility, and it's hard to coordinate a withdrawal strategy because of the tax withholding, like you mentioned, Corey, and the proportionate withdrawals. So, in our opinion, Corey, retirement deserves a proactive plan, not a passive leave it or rollover, right? So, we want to be proactive with the strategy before we do anything.
I feel like we just busted a myth, Jake.
Good job. All right. So, let's recap. So, this 401k decision is very critical. In fact, it merited a whole episode of Upticks because I think a lot of people are pretty nonchalant about it. And if you have analysis paralysis now, hopefully you've understand after today's episode that look, you could be making some big mistakes and costing yourself thousands of dollars in missed opportunities or high fees or structure, right? And so you want to evaluate your timing, when you do it, your tax strategy, all of your income needs, and use our 4-step framework to make an informed decision. Good. So please hit subscribe for more content
Yes.
on Upticks here. Again, download my book, The Retiring Right, Smart Steps for Exiting Corporate America. I've got more great content in that book. And as we wrap up, Corey, any other thoughts, anything else you want to share as we wind down today's episode?
No, I just want to. I'm going to give you a compliment, Jake. I think the framework, those 4 steps are really good because my experience of the last 15 years of meeting with thousands of people planning for retirement, Jake, is do I leave the 401k there or do I roll it somewhere else? Is the thinking and the question that a lot of people ask themselves first, when that's really probably the fourth question that we should be thinking about, especially as part of a proper
Yes.
financial plan.
Yes. Yes. It's the last step. So assess that plan quality. What tax planning opportunities are there? What structure do I have to, follow if I keep the money in here? How am I going to get income from this sucker? Right? What's that going to look like? And then do you leave it or do you roll it? That's how it should work. In fact, our regulators have really cracked down on this and for good cause, because I think a lot of advisors default to rolling it over without weighing these options. And if you're 56 years old
Right.
and you need to access
Yes.
your money and you've just retired and you roll it over, you might have to do something called a 72T, which is doable, but it's very complex. Where if you just would have left the money in there, you could have accessed it for a few years, 3.5 years or whatever, and not worried about doing some of these complex tax strategies. So again, work with a fiduciary wealth advisor, understand your options. Let's meet. If you've got a question, let's meet with our team we got 4 financial planners. They talk about this stuff all the time, Corey. Let's crunch those numbers and help you make an informed decision.
Yes, very good. And if you've got $1 million or $2 million in company stock inside that 401k, let's talk about net unrealized appreciation.
Yes, we definitely should
Don't
be talking
just
about
assume you
NUA.
should sell it and roll it over.
That's good. All right, Cory. So I got to ask. So lake life. This is probably the longest you've been in a lake, right?
Yeah, I think
you're
it probably
more of a
is.
city guy. You're more of a city guy. You're urban St. Louis guy.
That's right.
So what do you think? Do you see yourself ever having a second home down a lake? Lake. By the way, lake homes are probably the most popular thing that our clients have and spend their excess money on. So we have a lot of clients that have lake houses. But what are your thoughts now that you've experienced it? You've been down there a while, haven't you? How long have you been
Yeah, we got
there?
down here. We were here on Saturday, so I think 5 or 6 nights total is what we were spending here, Jake.
It's a long time with the in-laws, Cory.
That's right. We, I just lived with them for a month and a half while we were redoing our kitchen. So we've got a tight knit relationship, which is a good thing. But to answer your question, as far as a place at the lake goes, I think that my in-laws buying a place is pretty optimal, Jake, for me and for Cassie and for our daughter. So coming down here to visit, but it is really nice. It is a nice change of pace. I enjoy doing this here, though. I, of course, am looking forward to getting back to the office, but especially now with the baby and having a place we can even bring the dog to, kind of travel as a family. It is a nice change of pace, and we're enjoying ourselves.
Yeah, good for you. That's really cool, and that's the best. That's like people with a boat, right? It's the best thing about boats is having a buddy with a boat, not buying a boat yourself.
That's right.
So you got that now.
And we've got some clients down here too, Jake, that have retired and have moved down here. So I had lunch with some clients yesterday. So good to catch up with people when I'm down this direction also.
Yeah, good for you, Cory. I've never been a lake guy. I don't know why. Not a big
golf guy, Jake. You're a golf guy. You're a golf guy.
I'm a golf guy. Well, there's a reason I moved to the middle of the country. There's no water around. I mean, there's lakes, but there's no ocean. I am fine on land. Golf requires land, and I like land. So
you need to make a golf trip down here, though, Jake. There's a lot of golf.
I know. I need to. I don't like traveling, though. You know that, Cory.
That's true.
So
you stay in the office, Jake.
I'll stay in the office and keep working. All right. So that's all the time we have today. Thank you, Cory, for joining us down at the lake. Safe travels when you come back. And thank you all for tuning in. We hope you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website at www.falconwealthadvisors.com and click the Contact Us button if you'd like to meet with Jake and his team.